In Article 11.1, we saw about the right of the state of residence to tax interest income. When we talk about Article 11.2, this generally gives the right to the state of source to tax interest income. Let us now look at Article 11.2 of the India-USA Treaty to understand this in more detail. So what this article says is, however, such interest. Now, what is the significance of the use of word such interest? This means the interest which is referred to in Article 11, paragraph 1, which was the interest which was arising in the source state, plus it was paid to a resident of the other contracting state. So if there is interest which is arising in India and paid, then such interest may, the use of the word may indicates that it's the non-exclusive right which is to be there, also be taxed in the contracting state in which it arises. So which was the contracting state where the interest was arising? It was India, and according to the laws of that state, which means that the interest which is arising as well as paid and referred to in Article 11 may be taxed as per the domestic tax laws of India. So if the Indian tax law provides that the tax rate has to be 20%, that's what will be applicable. If the Indian state provides that it has to be 40%, that is something which will be applicable, right? But this is subject to certain exceptions. And what are those exceptions? But if the beneficial owner of the interest, right? What is a beneficial owner? A beneficial owner is a person who is getting the money and owning it on his own behalf. He has a right to use it in a manner in which he deems it to be fit. So if there is a beneficial owner of interest, okay, who is a resident of the other contracting state, which is US. Please note the word beneficial owner. It is not the recipient of interest which is relevant. It is the beneficial owner of interest who has to be a resident of US. And when I talk about resident, it has to be as per Article 4. So if the beneficial owner is a resident of US, the tax so charged. What is the meaning of tax? This is generally given in Article 2 and includes surcharge. But if the definition is not given, then you need to see the definition of tax as per the Income Tax Act. So charge shall not exceed. So if I summarize what we have discussed until now, what I said was, first point is, India has a right to tax interest payment according to its own domestic laws. But if the beneficial owner or the recipient of interest is the beneficial owner and is also a resident of United States, the tax so charged shall not exceed 10% of the gross amount of interest if such interest is paid on a loan granted by a bank carrying on a bona fide banking business or by a similar financial institution, including an insurance company, 15% of the gross amount in all other cases. So this rate of 20, 40, whatever it might be under the domestic laws is reduced to 10% or 15% of the gross amount if the recipient is a banking company, a banking business company, a similar financial institution or an insurance company, or 15% in all other cases. This all other cases would typically cover group loans. So if there is a FCO which has a subsidiary and it gives a loan to its subsidiary, that is something which will get in other cases, and therefore the tax rate will be 15%. So what are the key characteristics of this? The source state or India also has a right to tax interest and according to its own laws. But there's an exception which is dependent on twin conditions. One, if the recipient is the beneficial owner of interest and a resident of other contracting state, the right to tax in the source state is limited to a specified percentage. Tax shall include surcharge. While this may be applicable for India-US treaty, it's not a blanket exemption. You need to see what's the definition of tax in Article 2, if any, If no definition, local provision or domestic law provision may apply. The tax rate applies to gross interest, irrespective of the available deduction to the recipient on such interest in the state of residence. We'll look at an example on this. Rate of tax may differ if the lender holds more than specified percentage in certain treaties. So what these treaties say is that if there is a foreign company which owns more than some percent in the Indian company, let's say 26%, then the interest that is paid by the Indian company to the foreign company, the rate of tax will not be 15% as we saw earlier. It might just get reduced to 10% or any other percentage that the two contracting states may agree. Obviously, the credit for the taxes which are withheld in the state of residence have to be given.